As I was preparing to shoot this video, I thought, what better place than find out what scares people about mortgages than asking my friends. So I posted on Facebook 2 questions. One was for the person that has already purchased their first home, and I asked them, what didn't you know at the time that you wish you would have known? And the second was, for those of you that are shopping right now, what do you want to know? What don't you know? What would help you in this process? Or what are you scared about when the time is going to come? We had amazing feedback and great questions, and so those are the questions that we're going to address during this time. And there was so many questions that it's actually going to be a series. We're not going to be able to address them all today. We're going to have to do a series to answer all the questions that were asked and suggestions given to tell people that we're about to become first-time home buyers. The 4 most common types of mortgages is, the first one that's most popular is a conventional mortgage. That's the one the majority of the people do. It's not backed by the government in any way, shape, or form for the lender. They're not going to promise the lender and help if default happens. Again, it's the most common type for borrowers. Another type that is often talked about is an FHA loan, and that stands for Federal Housing Association. The advantage to an FHA loan is you can have a down payment as little as 3.5%. Now the disadvantage, because you don't have that full 20% down, is you're going to have to pay PMI, which means it's going to increase your monthly loan payment. Another type that is popular is VA loans, and those are Veteran Affairs, and that's for any person in the military and their families. The benefit to those is that they're could be 100% financing of the purchase price of their home. And then the last type we're going to talk about today is a USDA loan, and that stands for the United States Department of Agriculture. And those are available for people that live in rural areas and meet certain income requirements. The most common question asked about adjustable is, how is it different than fixed? And so fixed rates is what everybody wants and everybody knows and is a great product. And a fixed rate means that you have made an arrangement with the lender and you're going to pay this fixed rate for the life of the loan. So if you have a 30-year fixed, then your rate's not going to change for 30 years. However, a adjustable rate, or an ARM, has a possibility of the interest rate changing over time. And so you have made an agreement with that lender, and the first initial period is going to be fixed. So the most common one I've heard of is a 5-1. And so that means it is fixed for the first 5 years. At the end of the 5 years, it could change. And it could change every year thereafter because of the 1. And so again, you've made an agreement with the lender. You've said, this is the rate I'm going to pay for the first 5 years. And then after that, it could change. And in the contract, it's going to give parameters of how it could change. It's going to be based on some market factor. It's going to be tied to some index. It could be a certain amount over that index. And it's very important to understand the rules behind it, because what is the amount that it can change at any given year? How much can it increase over the life of the loan? How much can it increase in just one increment? ARMs really have a bad rap. There's a lot of people that really don't like them. They are a little more sophisticated, and I think you need to understand what you're getting into. The benefit to an ARM is you're going to get a lower interest rate than you would on a fixed rate. That's what is attractive for people, because their interest rate on that initial term is less than the interest rate on that 30-year fixed. Now the disadvantage and the risk is that it could change over time. And what is the interest rate environment doing? And are you going to be able to handle and be able to pay that increased rate if it does indeed increase?